one of my favorite strategies utilizing leap options is called the poor man's covered call, which works just like a traditional covered call, but with far less capital required. My promise was to you that I'm going to teach you everything, all the foundation, and get you to an advanced level with option trading. And the poor man's covered call is a really interesting variation of the covered call strategy. But the poor man's covered call gives you that power, the bicep over tricep, as I say. It gives you power, control, income. It's like the best of all worlds. The poor man's covered call is a way to generate income just like a regular covered call, but with far less capital required, very similar to a leap option. Because a poor man's covered call actually utilizes the leap option. And that's why this course is building on itself. Instead of needing to buy 100 shares of stock outright, which can be extremely expensive for high-priced stocks, this strategy uses leap options as a substitute for stock ownership. This allows for selling covered calls without tying up thousands or even tens of thousands of dollars. A traditional covered call requires owning 100 shares of a stock and then selling a call option against those shares, as we learned earlier in this course. This works great for stocks that are reasonably priced. Maybe a SoFi, maybe American Airlines. HIMS was a company that I was purchasing a lot and doing covered calls on. But how about those more expensive stocks like Tesla, Nvidia, Amazon? These more expensive stocks can use the poor man's covered call strategy, because instead of having to buy, Tesla for $30,000 or $40,000, a poor man's covered call can give you the same amount of shares for maybe $5,000, $6,000. So it's a lot more easy for everyone, even investors that do have more capital. Many of my clients, they like the poor man's covered call because it's fun, it's exciting, it's higher leverage returns. And at the end of the year, many of the people I work with, they want 50% or more returns per year. That's a lot to ask for. If you look at Warren Buffett, he has 24% per year. And I've maintained a 50% per year annualized rate of return, which is astronomically high and difficult. And the poor man's covered call has been a fantastic strategy that has helped me achieve those type of returns. It allows for the same income generation strategy, but at a fraction of the cost. Instead of buying the stock, the strategy starts by buying a deep in the money leap option with that traditional and standard delta that I have explained, the 70 delta. That's my sweet spot. So a leap call option has a long-term expiration. For the poor man's covered call strategy, we're going to be using the same expiration date. So this is going to be typically, 1 year out, maybe even 2 years out. If you have a stock that you really like and you see a long-term perspective on that stock, then it's completely okay to go for a long-term expiration. This long-term call acts as a substitute for stock ownership because it moves almost one-to-one with the stock price. A 70 delta, although it's not one-to-one, it's a very sensitive and it's moving a lot like the stock. And when you buy a call option that's deep in the money, you can then sell a call option against it. So once this long-term call option is owned, short-term covered calls can be sold against it, just like a regular covered call strategy. The reason this works is because the deep in the money leap has a high delta, meaning they have a very similar behavior to the stock itself. If the stock moves $1, the deep in the money leap option will move 70 cents. Let's go over a real example of how this works. Let's say that Nvidia is trading for $104 per share. Normally, buying 100 shares would cost $14,000, which is a big amount of capital commitment upfront. Yes, it's possible, but what if we can get it lower? Well, let's talk about the leap option. A deep in the money leap option that you can buy for $100 per share, right? At the $100 strike. Let's say that it's out 12 months. This leap option you can purchase for $30 per share, meaning that the total cost is $3,000 instead of $14,000. At this point, the long-term call option is acting as a substitute for stock ownership. Since it's deep in the money, it behaves almost exactly like owning 100 shares, but at a much lower cost. Now, just like in a regular covered call strategy, a short-term call option is sold against the leaps. A 150 strike call option with a 30-day to expiration, and it's sold for $2 per share, meaning $200 in premium collected immediately. Well, we have just collected $200 in premium for 30 days. $200 is not that much compared to $14,000, right? If you were to buy this entire stock, 100 shares, $14,000, $200, that's like 1.5% or so. That's about 1.5%, right? But if you collect $200 on the leap option, and the leap option that we purchased for $3,000, well, we collect $200 on $3,000, that's a 6.667% return, or, so it's 6.67% return. That is freaking phenomenal, because on the covered call, you would make like 1.5%. With the poor man's covered call on a monthly basis, you can make 6.67%. And I didn't even tell you about the capital appreciation. That's the premium component, because there's multiple sources of income that you can make from the poor man's covered call, which I'll discuss in just a moment. But I want to talk about the outcomes, okay? What are the outcomes of the poor man's covered call? If Nvidia stays below 150 by expiration, the call option expires worthless, and the $200 premium is yours kept as profit. Same thing as a covered call. The $200 that you collect, it's yours in your pocket right away, but you actually want it to, expire worthless, and then that $200 is like officially yours, right? $200 in cash is yours, but you still have the position in your account, so you might have to buy it back. So you need the option to expire for you to be able to sell another option. You can't just sell an option and then sell another one of the same shares. You see what I'm saying? So a new call option can be sold after a month and repeating the whole process and generating consistent income in the case that Nvidia stays below 150, right? So if it stays below 150, the option expires worthless, and then you can run the strategy again and collect another, 6-7% in premium for another 30 days. If Nvidia rises above 150, this is actually pretty good overall. Not pretty good, this is actually really good, because a short-term call will get exercised, and I'll tell you how to manage the strategy because you actually don't want it to get exercised. I'll go over that in just a moment. But in theory, if it goes above 150, you will basically lose the covered call that you sold, and then the long call will be really deep in the money, so it'll make a lot of money. So what I usually do actually is I usually close out the position entirely for a profit. So if Nvidia were to hit 150, I personally, this is, Henry, what I do, I would basically close out the position. So the long call option is like made a lot of money. The 150 call option that's sold, the covered call, you'll have to buy it back for some money, right? But the net position will be up a lot because this is a bullish strategy. And I'll show you an example of the poor man's covered call, just a few minutes. We'll go over a live example. But the long call has a lot of delta, so it's really sensitive. So the long delta, and you've made a lot more money because it has participated a lot more in the upside versus the short call option, it has not really participated that much on the downside. So even when it hits 150, just close out the entire position and you've literally made money hand over fist, like a lot. This strategy works because a long-term leap call is a cheaper way to gain exposure to a stock while still allowing for the covered call to generate income every single month. So instead of needing like $14,000 to buy like Nvidia, for example, you can buy 100 shares for like literally, 1/4 of the cost. The key to success with this strategy is choosing the right leap contract, and the best leap contract is again going to have that 70 delta. You obviously want to have some good stock selection because this is a bullish strategy, and the strategy itself won't save you from like a crappy stock. Like you have to have the proper stock that's going up. It has to be like either a 52-week low, the RSI has to be low, so like most likely it'll go up. It might be near a Bollinger Band bottom, or just in general, you're just bullish in the stock. Like you don't have to do the technical analysis side. Fundamentally, it can just be a good company. Like maybe the price to sales ratio is very reasonable. Maybe the price to earnings is really reasonable. Maybe the company in general is just really growing and you're bullish on it. So there could be a lot of reasons to run this strategy. And again, the leap option that I'm buying is always going to be roughly in that 1 year mark. And that's because the theta decay on a long-term leap option is really low. So theta is really affecting the option very slowly. So this is why the strategy works best when it's initiated with at least 1 year, give or take, maybe it's a little bit more. It can even be a 6 to 9 month option expiration as well. That way, it actually have a huge other benefit because the leap option that you buy has very low sensitivity to theta. So you have a long time that you can hold that option and it's not really decaying and it's deep in the money. So like you're cool, you're basically holding stock. Whereas the short call, that option that you sell is losing value quickly, which is a good thing because you have sold that call option, right? So it's decaying and losing value. And essentially, the long call option is not losing value fast. The short call option is losing value fast. So you see how like you're profiting. So even if the stock does like nothing for 2 months, because I'm selling either monthly or every 2 months call options, then I'm just profiting off of theta decay because the theta decay is higher on the short call versus the long call option. So let's go over an example of this and pull up an option chain and show you the poor man's covered call in action. I actually have several covered calls that I have done on Google. So I'll show you like a Google example, and I'll demonstrate to you buying the leap option, selling the call option, and how the trade works out, the performance of those trades. So again, let's go over some live examples so you can see. I'm going to open up an example right now that is going to have a roughly 30% return on the poor man's covered call. So let's go through it step by step. First thing I want to do is I want to buy a call option on Tesla. Okay, I'm going to be buying a call option for January. And again, this is an example. You don't have to use Tesla. You can use any other stock that you like. So I'm going to buy call, and the expiration date that I'm going to pick right now is going to be for January 16. I'm going to purchase an in-the-money call option that has a roughly 70 delta, which is my sweet spot delta. Right here you can see the delta is 0.69, which is close enough. The volume is, it's fairly low actually, but the open interest is good. The implied volatility is 55.95, which is great. And the bid-ask spread is actually really good for an option that's pretty expensive at $9,600. Now, let me show you how this would work. So if you buy this call option right here, this call leap option, which goes out, pretty much exactly 1 year, I'm now going to sell a call option against this leap option and generate some income. So if I go for a 3-month expiration, this would be basically a quarterly expiration, very low amounts of work. And I want to specifically show you the 330 is a 70 delta, but how do you pick the, the call, the poor man's covered call that you sell? So I want to bring up Tesla's chart right now and show you, how to actually pick that strike. So you see, as I'm recording this, Tesla has, basically fallen a lot. It's at the bottom of its Bollinger Band at 361, and the moving average is 405. So for me, I think, on average in the past, 50 days, or 60 days of this moving average. This is actually a 50-day moving average. In the last 50 days, it's essentially about $400 on average, okay? So if I look at, what is likely to happen with Tesla, I would say that, if it goes up, it'll be between, somewhere around 400, maybe 420. The top of the Bollinger Band here is 437. So what the Bollinger Band means is it's statistics. It means that 95% of the time that Tesla is going to trade between the bottom of the Bollinger Band and the top. So the bottom here is around 365, and we're actually below the bottom of the Bollinger Band. So it's something really unusual at the moment to see Tesla, this low. And, if Tesla were to be, 450 in, February 2025, it would be fairly expensive based on the Bollinger Band. So the Bollinger Band uses statistics to tell you where a stock is likely to trade within. So for me, I have two pieces of data. I have, the moving average 405, and the middle of the Bollinger Band is essentially 400. So I'm going to go with 400. 400 is perfect. So if I go to sell call and I go for the 400, you'll see here how I can essentially collect $2,900 from the call option that I'm selling. If you take essentially, $2,900 and you divide it by, the 96.90 that you're paying, then you're basically getting almost a 30% return or thereabouts. So you can see here how there's a huge profit area. The profit is actually really, really big. And this option right here will, and this option right here, it's already in the money. So even if Tesla doesn't do a whole lot, you're still gonna see, an expected profit. But if Tesla goes up, you will make as much as $4,500. Now, this is really interesting because the way the option behaves is pretty dynamic because you have two different expiration dates. The long call option has a very high delta, so it's going to be benefiting a lot. Whereas the short option, the 400 call, what you ideally want to happen is you want Tesla stock to rise towards $400 per share. Therefore, your 330 call option goes up. And then, if Tesla goes up towards 400, but it doesn't like massively jump and just approaches 400 and it rises to say 370, 380, 390, then the short call option is still going to be decaying in value until expiration of, May 16 expiration. So let's say it's like April and Tesla is at 375 per share. That's actually really good because the long call option has increased in value and theta has already really kicked in a lot for the 400 short call option. So you're going to be up on the position. The estimation will vary a bit, but if we wanted to like manually do that estimation, this chart right here on Robinhood, it's not so good with poor man's covered calls. This gives you like a rough idea, but the true calculation, you can either kind of estimate it yourself or you can use some scenario analysis maybe using some other tools. But the poor man's covered call is a little bit more difficult to really like fully analyze in Robinhood because it's a free trading platform. And the way that these two interact with each other is a little bit different from this chart, okay? This chart is not really taking into account, this chart is showing you basically what happens at expiration, right? So let's say at expiration, it's, you know, it's $400, then yeah, essentially you have paid $6,700. This call option right here would be, you know, $70 in the money. So you would have 70, and then this would, you know, expire worthless. So, you know, 70 plus 29 is 9,900. So essentially you can look at it that way, but there's several ways you can really look at it. At expiration though, you can't even fully do that because this option right here expires in May, whereas this option expires in January. So you see what I'm saying? This option that's being calculated isn't really factoring in time. So that's why, you know, I wouldn't really use Robinhood for the calculation fully, but you can understand here that this is a bullish strategy and more or less this is what it looks like. As time goes on, if your option increases in value, then this leap call option will increase in value and this option will decrease in value. And if a jump happens in the short term to 400, you won't really be up as much as it going to 400 by May 16. So at May 16, if it's exactly 400, then, you know, this will basically be zero. But let's say that in a week or 2 weeks, Tesla jumps to 400. Well, let's actually do the math there. I can show you what would happen in 2 weeks and we can go over certain scenarios. So let's just say, let's go back to the call option that I purchased and just do the math separately. And I'll just break it down for you step by step so you understand what I mean here. It's not as easy on the poor man's covered call to get the expected return of what it's actually gonna be. So let's break it down step by step. For example, if Tesla went to $400 per share, it would see a roughly $40 rise. Let's say this happened in 2 weeks, okay? So in 2 weeks, this would be your profit. This is how your long call option will be affected and your short call option will be affected. Your long call option, right? This 330 long call option, it has a 70 delta. So if Tesla goes up by $40, you'll see this on the screen, $40 times 70 delta is $28. You're gonna make $2,800. Theta is super low here, so in 2 weeks, like you're losing $11 times 7, that's like $77. In 2 weeks, you're gonna lose like $140, okay? So let's, instead of saying $2,800, let's say this option goes up $2,700 because theta kicks in a little bit. So you see what I'm doing there? I'm multiplying delta by the amount that the stock goes up, which is $40 times delta. And then I'm subtracting out, you know, the 2 weeks of theta. Right? So it's $2,700. Perfect. But we wouldn't be up $2,700 because on a poor man's covered call, the short call option does work against us. You know, it's premium that we collect, but it also does work against us if you get a short-term move. So let's go back to sell call and talk about what happens to the short call option because this is really interesting. The 330 call option will go up in value. We already know we made $2,700, but what happens to the short 400? Well, what would happen is that the short 400 would essentially, it has a 40 delta, right? 40 delta times 40. So it would essentially rise about $16, okay? So you can see here, it would rise $16. And theta here would also eat away at the option, actually a little bit more. So it's actually a good benefit. So 7 times the theta, which is 1 week, it would lose $20 times 7, which is 140. So in 2 weeks, it would be 280, right? So let's call it $300. So $300 it would lose, which actually helps us. It actually works in our favor. So on the short call option, theta works for us. On the long call option, you know, I was saying that if it's 2,800, but we subtract theta, right? We go down to $2,700 in profit. So when we sell this option, you know, if Tesla goes to 400 or increases by $40, then, you know, it's going to be working against our covered call because with a short call option, you want the stock to stay below the call option. So what happens here is that it'll be $1,600 against us, right? Because 40 times the delta is 1,600 roughly, but it actually helps us by 300. So instead of 1,600, it's really 300 less. So it'll be 1,300. There you go. So now I've kind of did the rough math estimation for you because, you know, again, Robinhood's not gonna know, like, in what depends on the time frame, right? This is why delta and Greeks is so important for you to understand more or less how this is gonna work out ahead of time. So again, the first option, the call option, will be up 2,700. The second call option will be up 1,300, right? The 1,600 minus the 300 of theta loss. So 2,700, we're up, 1,300 will be down. The difference, 1,400. $1,400, okay? So that's the estimated difference. So yeah, if the total cost here is $6,800 and we end up making $1,400, that's like, you know, almost 1/4. That's almost like a 1/4 return. So yeah, you'll be up like, say 23%. I'll put up on the screen, which is the 1,400 divided by 6,790. It's gonna be about 23%, whatever that number is on the screen right now, which is like a really good return in 90 days. Voila, 20-something% in 90 days. And keep in mind that if Tesla goes up by $40, keep in mind that the stock, that would only be like, you know, like a 12% rise. So the stock would go up 12%, but the poor man's covered call would go up by 22%. So this is obviously like amazing and really good. Now, the true benefit with the poor man's covered call, let's actually do the second example of Tesla going to 400 at expiration. This one would be a lot easier to do. So at expiration of the short call, because we have two different expirations, right? At the expiration of the short call, which is May 16, essentially the May 16 option would be worthless, right? Because if Tesla goes to like 400, but it's May 16 already, the option expires. So it'll be like in positive 2,900 for us. And that means that we just basically only have this call option, which, you know, will go up by, you know, let's go back to the call option. So if it's $40, well, actually, no, we can pretty much do the math. So it was around a 70 delta. So 70 times 40 will be 2,800. So we made roughly 2,800. Yeah, theta will be more of a problem by May. So let's just estimate and say we make $2,000. The short 400 call will for sure lose 2,900. So we made like $5,000 on this position, which is like some pretty good numbers. That's like 75% or so, or even more. So we'll make a lot of money on Tesla. I hope this example was really interesting to you. I'm gonna go over another example where I can show you more numbers. This is me doing a lot of estimations in my head. Comment down below if you found this valuable. I hope I didn't lose your attention with that. But let's go over another example where I can actually show you everything. Some of this stuff on Tesla was a little bit theory-based because the poor man's covered call, again, it's a little bit more not theory, but it's hard to calculate because there's two different expirations. So you kind of have to understand options on a deeper level. Let's go over this Nvidia example right now, because this is actually a poor man's call that I currently have open, and you'll be able to see the profit loss that I have on this Nvidia option strategy. So I opened up this option strategy in my Discord end of January. So this was like last month. And you can see here how I entered a 2 option order and it got filled. And basically what happened was I sold, so no, first of all, I bought Nvidia 110 call, then I sold Nvidia 128 call, right? This is a poor man's covered call. And here's the option positions in my portfolio right now. So here's the breakdown. Essentially the 110 call is like that call option, the leap option that had, you know, a decent delta. I don't know what the delta is right now. Let's actually take a look and see what the delta is. This position has obviously changed. Nvidia has fallen down a bit. But, you know, my delta is actually pretty good. It's at 74. So not a whole lot has changed. So I have a 110 call and then I have a 128 covered call. And Nvidia just hit in the money. So we're about to hit some really interesting conversations because this is like a good opportunity to roll. This is like right at the money. So what am I doing right now and how am I managing it? So the 110 call, like things are obviously going well there. And the 128 covered call, Nvidia just hit in the money. So it's time for me to potentially like roll this option. It's also really interesting because today, as like I'm recording this, it's like February 9th, 2025. And Nvidia, this covered call is expiring on February 21st. So I'm really only about 12-ish days away. So I have the ability to pretty much this week, when the market opens up, to roll this higher. So I'll show you rolling higher. But first, I want to talk about how much I'm up and potentially just closing out the trade for a profit. Because the simplest thing to do would just be to close the trade out for a profit. I'm up $1,650, as you can see here. So I don't really need to roll. I can either close this position out fully for a profit or I can roll. The reason why I can also roll is because this leap option still has time. It's expiring in September. So, you know, it's still a leap option. If this was like May, I would definitely say 100% I'm taking profit, I'm closing out this trade because the leap option is about to hit some faster time decay. Right now, it's not really in that fast time decay like space, right? Like there's still some more time and time decay is currently low. So I have 2 choices. I kind of have 3 choices. So the first choice is I can cut this position when the market opens. I'm recording this right now on a Sunday. So when the market opens up Monday morning, I can just take profit and walk away $1,650, which is like 10% return in like less than 2 weeks, like making stupid amounts of money right now. So I can do that. I can also roll this position higher. So I can roll the 128 to, 135 or something like that. And the third thing is I could just wait, and I can wait until closer to 221 because it just hit in the money, but it's not like massively in the money. So this option will actually experience a lot of time decay. And number 3 is what I'm going to do actually, because you're part of my Discord, like, I like to do my rolling and trading on Wednesdays. Mondays are like I'm opening new positions. Wednesdays I'm doing a lot more like rolling and adjusting positions. So I probably won't do anything until Wednesday. But yeah, honestly, you can't really go wrong. So there's no better choice. The first choice of taking profit now is cool, right? Like you take your profit, your capital's freed up, you could do something else. Choice number 2, you can roll up, and I'll show you what that looks like right now, is actually also a good choice. And then choice number 3, which is just waiting a little bit more, is also phenomenal because waiting a little bit more means that this option is going to gain value. So I'm basically giving you 3 ways to win. This is all 3 ways winning, but I would probably prefer waiting and rolling a little bit more than taking profit right away. Taking profit would be for the people that are like, I'm happy, I'm really scared to lose my money, I want to get out of this position. That's fine. But typically when you have a lot of experience, you are probably going to say, I want to make more money, I feel confident, so I know what I'm doing. So this option is actually down, which makes sense because it's now in the money, but it's not actually down that much because there's not that much time, so there's not that much extrinsic value here. There's extrinsic value for sure. I mean, the extrinsic value right here is like exactly $5. This option's in the money by 70 cents and the option's worth $5.70. So its extrinsic value is $5 and its intrinsic value is 70 cents. So yes, there is a decent amount of extrinsic value, but that's all gonna like go away like really, really fast. It's like a car that's depreciating. Like you buy a brand new Lambo out of the place where they sell the Lambos at. I don't have one, so I never even like bought a car. I would just rent them. Like when you buy a car and you drive it off the lot, I know you guys have heard like it loses like a lot of its value, right? It's 20% or something like that. Well, the same thing with this option. It's about to hit some big depreciation. This option is about to depreciate faster than a Lambo that you just bought and you put 3,000 miles on it, because in 10 days, 12 days, it's going to lose. If the option stands still, if the stock stands still at 128.73, this option is going to lose all of its extrinsic value, which is $5. It's going to lose all $5, which is a lot. AKA why I would personally lean on waiting and not touching this option. That's what I will do. So this option will basically make $2,850, which will be like a load of money because we put up 11,900 on this trade, right? If you recall, this trade is 11,900. So making like 3 grand in 11 days is exactly like why we got into this position to kind of like begin with. So taking profit would be like a little early in my opinion, because you got 10% when you can get like 3 grand more to the already 10% that we have. That's going to be like an extra like 20% or so. I'll put on the screen. What is 2850 divided by 11,900? That is what you will be leaving on the table if you were to essentially close this option out for a profit. So choice number 1, closing it out for a profit. Viable, winning, it is leaving money on the table. 2, waiting would be my preferred choice, to wait and not to manage this position. I actually love waiting and doing nothing. It makes my life so much easier because I am working with I think 30 one-on-one students right now, and I text them back and forth, right? It's texting, it's images, it's voice notes, and I go back and forth, and I love being able to honestly say like, it's better to wait and actually mean it. Like, hey, I'm not being lazy. It's actually better to wait. Like doing less is actually more, and I feel like good about that. I'm not like saying to do something more because it's like profitable to do more for me. It's like, this is the honest to God truth. It's better to wait. Now, number 3, which is rolling, I would say that this is also viable, but probably not optimal, just like taking profit isn't optimal. And again, I don't know how this is gonna turn out. So you're watching this in the future, right? It's gonna take me a lot of time to edit this video, a lot of time, weeks. So by the time it comes out, like you'll see how this played out. You'll see, oh, was I right? Was I wrong? But you can't even judge someone based on a short time frame anyways. It's all about long-term investing, because I had plenty of periods where I wasn't right on a single trade, but I've been right on many trades, and then I've grown my wealth to like millions and millions, and it had bumps along the road. Like I didn't like, it's not a straight line. Like obviously it's not. So I've had my fair share of mistakes, and I still make mistakes. I'm still like, I would say learning, 11 years in learning, but you know, sometimes I look back, I'm like, I could have done something a little bit better. I should have seen that. You know, I'm still always improving a little bit. Let's go over like the rolling scenario. So rolling, from what I understand, you cannot roll a piece of the poor man's covered call in the Robinhood platform. So what you do instead is you close out the call option, you close it out, and then you open up a different option in 2 transactions. So for a covered call, you can roll it. For a spread or a poor man's covered call, you can't do that in 1 transaction, from my understanding. And I've been using this platform for a long time. There's really no loopholes. You just close out and open up. It's really not that hard. I just want you to be aware of that you're not going to see the roll button. So that's why you don't see a roll button right here on the screen. So instead, what you will do is you will close out. So buy to close, you'll close this out for 580, right? So let's actually put both options on the screen as if I was buying them, so you can visualize both. So let me go to February 21st, and then this option was a sell. Well, I would have to be buying it back to close it, right? So I'll go to buy. So buy, and then 128 right here. So you can see here, I can buy it back for $580, and I can essentially sell a new like covered call leap option like next month, which would be 40 days out from the expiration here. And I can essentially move from 128 to say like 135, as I mentioned before. So check this out right here. This is actually, I did a mistake. It shouldn't be buy, it should be sell, right? So we're trying to sell a call option because we're trying to collect premium on the 135. So if I like collect the 135 here, you'll see that the 128 I can buy back for 580, and then the 135 I can sell for 870. And I can essentially collect $290 of premium. I still, the $3,000 I was talking about, I still will make that, because this is $300 on top of what that option was worth, right? The 128 call option was worth $2,850. And now the 135 call option that I'm selling here, it's still $2,850, but it's $290 on top of that. Okay, so yeah, so this would be amazing, right? This is like awesome stuff. And by the way, this is per contract. So the total credit would be $290 per contract that you basically close and then roll and have an open new position. So for every single contract, I would collect $290 more per contract by rolling higher. So obviously this roll higher allows me to now, you know, benefit off of Nvidia going to 135 rather than Nvidia going to just 128. And then I just wanted to go back here real fast, because I just realized in my head, I'm like, well, the position is 2850, right, for the call option, but how many shares would we be rolling? We'd be rolling 5 contracts here. So I have 5 contracts of this 128. So 5 contract roll, you saw was 290, right? So let's call it $300. So if I would roll 5 contracts for $300, it'd be $1,500, which is essentially like a 50% bonus. So yeah, you know, if you need to watch this example again, make sure that you can like rewind and rewatch it. There's 3 ways to manage the poor man's covered call, at least this example. There is the first one, which is taking profit and just being happy with what you've made, which is $1,650 right here. And then just saying, hey, you know, I made 10% in like 10 days. I'm happy, I'm good. Number 2 would be waiting more, because this option right here will decay like pretty quickly and really fast. So that is a really huge component to your income. And this option won't decay that fast. So in like 11, 12 days, as this option approaches expiration, it's going to decay and you're going to make a lot of money. And the third way is to roll this position. And to be honest, like rolling is like chess. Like I've been playing chess recently. I played poker. I've been very successful at poker. I'm not as good at chess as I am poker, but you know, there's like lots of moves in chess. Like there's tons and tons of possibilities. So the same thing is like with rolling. That's why it's like, it's a case by case basis. Like you can roll Nvidia to 129, 130, 131, 135 to this expiration date and that expiration date. You can roll it up, down. You can roll it for the same strike price, but further in terms of date. And there's just various benefits to that. So I encourage you to play around, and I'll definitely have more examples in this course. And of course, like in my coaching, more than happy to help you as well. You can always check out the first link in the description. Now let's continue on with this course and continue to learn.